Most Singaporeans turning 55 this year will leave 47,000 Singapore dollars in compounding returns on the table from one avoidable supplemental retirement scheme decision. Before we get into the numbers, I want to say who I am doing this for. Not the trader with a 20-year runway, not the growth chaser hunting the next 10-bagger. I am doing this for the retiring and retired Singaporean who needs their capital to work reliably, not spectacularly. When you leave your funds sitting in the default bank setup, your cash is earning a miserable 0.05% interest. To put that in perspective, your CPF ordinary account pays 2.5% guaranteed and your special account sits at 4.0% guaranteed. Moving your money into a temporary tax shelter without an investment plan is not a retirement strategy. It is a highly organized way of losing ground to inflation every single day. Let us look at who needs to fix this immediately. This forensic breakdown is built specifically for Singaporeans aged 45 to 65. I am not talking to the short-term trader hunting for volatile 10-baggers or trying to time the next growth wave. This is for the retiring or retired retail investor who needs their hard-earned capital to work reliably, safely, and predictably, not spectacularly. Over the next few minutes, we will unpack the structural rules of the framework, dismantle the 3 fatal mistakes heartland portfolios make, and lay out a clear, numbers-driven roadmap. The core misunderstanding among retail investors is treating this framework as a tax elimination tool. It is not. It is a tax deferral vehicle. The mechanics are simple. You reduce your taxable income today when your earning power and tax brackets are at their absolute peak. In exchange, you agree to pay income tax on those distributions much later in life, at a point where you have stepped down from full-time work and sit in a significantly lower or even zero tax bracket. For Singapore citizens and permanent residents, the government caps your annual contributions at 15,300 Singapore dollars. If you are a foreign resident working here, that annual limit is 35,700 Singapore dollars. Every single dollar you move into the account reduces your assessable income by a full dollar for that year, subject to the absolute personal income tax relief cap of 80,000 Singapore dollars across all categories. But remember, the real wealth generation does not happen on day one. It triggers when you execute the withdrawal strategy. And here is exactly what that withdrawal strategy unlocks. At your statutory retirement age, the government hands you a 50% tax exemption on every single distribution you take. Only half of each annual withdrawal is added to your taxable income. The other half, completely invisible to the taxman. Now pair that with your 10-year distribution window. If you sequence your withdrawals carefully alongside your personal tax-free threshold, you can extract substantial 6-figure sums from this account with zero tax liability, not minimized, zero. Think of it like getting a high-value discount voucher at your favorite hawker center. You queued for it, you earned it. But if you walk home and leave it in your wallet until it expires, you got nothing. The 50% exemption is your voucher. The 10-year window is your redemption clock. The only question is whether you have a plan to use it before time runs out. Looking at the core metrics, for a Singapore citizen or permanent resident maximizing the $15,300 annual cap, the numbers scale dramatically with your income bracket. At a 15% top marginal rate, your annual tax saving is 2,295 Singapore dollars. If you hit the 19% bracket, that saving rises to 2,907 Singapore dollars and tops out at 3,366 Singapore dollars for the 22% bracket. For foreign residents saving at the upper tier, the maximum annual tax relief reaches 7,854 Singapore dollars. The first systemic error heartland investors commit is waiting until the final week of December to execute their top-ups. Treating your retirement planning as an end-of-year tax afterthought means you are throwing away 12 full months of vital compounding growth every single calendar year. When you repeat this pattern over a 10 to 20-year career horizon, that persistent timing delay creates a massive, irreversible gap in your final nest egg. The second error is the absolute biggest act of wealth destruction in local retirement planning, keeping your balance in cash earning 0.05%. Even a standard 6-month Singapore Treasury bill recently offered 1.45%. But let us be honest, even that risk-free alternative fails my personal 4.7% minimum yield hurdle, the baseline return required to justify stepping out of guaranteed CPF rates. Parking your funds in default cash means you are choosing to accept guaranteed losses to inflation. The third structural mistake is failing to build a rigid withdrawal architecture. If you pull any money out before your statutory retirement age, you face an immediate 5% flat penalty on the entire sum. To make matters worse, 100% of that early withdrawal is slapped onto your taxable income for that year, which instantly pushes you into a much higher tax bracket. Without a precise distribution timeline, your funds will overlap with other income streams, creating an unnecessary tax bill. The fix here is actually simple. Your retirement capital must be actively deployed into productive income assets, never left to park in cash. However, as forensic investors, we must recognize that every single investment decision involves real friction-filled transaction costs. Entry costs matter immensely from day one, because if you start your journey in the deep red, your margin of safety is instantly compromised. In the world of dividend investing, we spend a lot of time talking about the yield spread, the difference between what a stock pays you and the risk-free rate. But there is a hidden leak that most retail investors completely ignore: transaction friction. If you are deploying 10,000 Singapore dollars into a Singapore REIT and your broker eats a chunk of that in minimum commissions or platform fees, you are starting your investment in the red before you have even bought a single share. Data is only useful if you have the tools to act on it without getting eaten alive by those fees. That is why I use Longbridge. They are currently the only platform in Singapore offering lifetime zero commission circumflex for US, Hong Kong, and Singapore stocks. Their data visualization is also some of the fastest I have used, which is critical when you are timing an entry in a volatile market. To help you plug that leak, I have partnered with Longbridge on an exclusive arrangement for my viewers. For the first 10 readers who open and fund an account with a minimum of 10,000 Singapore dollars, Longbridge is offering a direct 100 Singapore dollar asterisk cash credit on top of their already generous June welcome rewards. Here is what the full package looks like if you deposit $10,000, hold it for 90 days, and complete 5 buy trades. You receive the exclusive $100 cash credit. You receive 300 Singapore dollars worth of NVIDIA fractional shares. You receive a 5% per annum interest boost coupon valid for 365 days on deposits up to $4,000 worth up to 200 Singapore dollars over the year. And you receive platform fee coupons worth up to 450 Singapore dollars across US, Hong Kong, and Singapore markets. All of these stacked together, you do not have to choose between them. Why does this math matter to a forensic investor? Because $100 on a $10,000 deposit is an immediate 1% day one yield boost before you have executed a single trade. Combined with the interest boost coupon hash and platform fee savings, the total welcome package meaningfully neutralizes transaction friction and protects your margin of safety from the moment you fund the account. This is strictly limited to the first 10 spots. The link and full terms are in the description. Other fees and terms and conditions apply, so read those carefully before you proceed. But for a forensic investor who cares about entry cost and yield from day one, this is worth 5 minutes of your time. Once your funds are settled inside the ecosystem, you have access to a specific suite of approved instruments, including local blue chip equities, real estate investment trusts, exchange-traded funds, retail bonds, and institutional unit trusts. Note that you cannot use these funds for alternative central provident fund instruments that strictly mandate ordinary or special account capital. From a strict forensic standpoint, our asset screening process requires a hard metric filter before any name enters the portfolio. Any asset you buy must clear our mandatory 4.7% minimum yield hurdle. This threshold is calculated by taking our absolute forensic floor of 3.2% and adding a non-negotiable 150 basis point risk premium. This premium is required to justify moving your money away from the guaranteed, risk-free 4.0% return of your CPF special account. If a local stock or REIT cannot reliably clear this hurdle, it has absolutely no place in your retirement portfolio. The single biggest optimization error Heartland investors make is treating this account as a standalone tax hack instead of integrating it directly with their wider CPF balances. They happily celebrate a $2,000 tax saving today, but completely ignore the fact that their idle cash loses 3.5% in real purchasing power every single year compared to the risk-free CPF alternative. Over 15 years, that uninvested capital completely wipes out the initial tax benefit. Your retirement architecture is a unified machine, and every dollar sitting at 0.05% is a structural failure. Built for long-term yield, not just immediate tax gratification. If you sit in the accumulator phase between the ages of 45 and 54, your core strategic objective is maximizing your yield to risk efficiency. Your capital has a multi-year runway, meaning it needs to be compounding aggressively. You must shift your contribution execution from December to the first week of January immediately to capture those extra months of growth and focus your asset selection entirely on corporate balance sheets capable of sustaining distributions above our 4.7% threshold. Once you cross the age of 55, the focus shifts completely, from building to sequencing your exit. The CPF board will automatically carve out your retirement account using your existing ordinary and special account balances up to the full retirement sum, which stands at 220,400 Singapore dollars for members turning 55 in 2026. At this stage, You must map out your liquidation timeline well before hitting your statutory retirement age to prevent high tax overlaps. Let us look at the dramatic divergence in terminal value over a 10-year horizon based on an annual $15,300 contribution. If you leave it in cash at 0.05%, your terminal value stalls at $153,344. Moving to a treasury bill alternative at 1.45% yields $163,405. Reaching the forensic floor of 3.2% drives that to $177,021. While hitting our minimum yield hurdle of 4.7% scales your nest egg to $189,768. The structural rules of the withdrawal matrix are completely uncompromising. If you withdraw before your statutory retirement age, you face a 100% taxable portion alongside a 5% flat penalty, making it highly inefficient. If you execute exactly at your statutory retirement age, your taxable portion drops to 50% with zero penalties, which is highly efficient. The optimum strategy is spreading those distributions systematically over a 10-year post-retirement window, maximizing your personal tax-free thresholds across a full decade. To see how this operates in the real world, let us track a live case study. Meet Tan, a 53-year-old corporate manager living in a 5-room HDB flat in Bedok. Tan is a hypothetical profile designed to show real-world numbers. He plans to step down from full-time work at age 65, holds an active CPF ordinary account balance of $220,000, and currently maxes out his annual top-ups. His core problem is that he has $100,000 sitting completely idle in default cash. To fix this leakage, Tan decides to reallocate that capital into high-quality local banking assets. Turning to our banking allocations, Overseas Chinese Banking Corporation holds our highest Zone 1 Fortress rating due to its exceptional capital buffers. The bank's Common Equity Tier 1 ratio stands at an incredibly resilient 15.2% on a fully phased-in basis as of the first quarter of 2026. Simultaneously, its non-performing loan ratio sits at a mere 0.9%, signaling a highly conservative loan book that is well insulated against macroeconomic distress. This combination of a massive capital cushion and an exceptionally low default rate is precisely why the bank secures its fortress status. For an investor like Tan, deploying idle retirement funds into an asset with a 0.9% non-performing loan ratio provides the ultimate peace of mind. It ensures that his underlying income engine isn't exposed to reckless credit risk, allowing him to build a defensive dividend foundation that can reliably fund his upcoming distribution phase. To finalize his retirement plan, Tan maps out his projected annual income streams from age 65 onwards against his expected heartland living costs. His baseline CPF life payout delivers $1,950 a month, clearing our guaranteed state floor. His structured annual drawdown provides an additional $1,250 a month under the tax-exempt concession. Finally, his local dividend portfolio contributes $1,100 monthly, clearing our 4.7% screening metric. This brings his total monthly retirement income to $4,300. When we weigh Tan's total income against his baseline heartland living expenses of $3,500 a month, his unified architecture clears the hurdle with ease. This leaves him with a positive monthly surplus against need score of 800 Singapore dollars, which translates to a resilient annual surplus buffer of $9,600. This surplus acts as a critical sanctuary, ensuring his lifestyle is fully protected without ever needing to erode his core capital base. When projecting local dividend income against guaranteed state funds, we must always apply a conservative asset floor of 3.2%. We engineer our portfolios for the severe economic storm, never just the sunny day. While individual short-term treasury bills might fluctuate around 1.45%, we do not lower our forensic standards to chase temporary market dips. Our base floor remains fixed at 3.2% to ensure your sanctuary holdings can easily withstand a normalization of long-term interest rates. The silent, dangerous second-order risk that most retirement plans completely ignore is reinvestment risk within the 10-year withdrawal window. If Tan hits a severe, prolonged market downturn at the exact age of 65, he will be legally forced to liquidate his equity holdings to meet his mandatory annual distribution schedule. Selling high-quality dividend-paying shares into a deeply depressed market permanently locks in devastating capital losses. To insulate your retirement engine from this specific trap, you must build an independent cash runway entirely outside the ecosystem to preserve your core compounding machine when markets roll over. If you want zero-day access to my personal forensic watchlist, the active red zone registry, and institutional-grade analytical cheat sheets on every single local name I cover, Iggy's Elite Investors delivers all of that for just 9 Singapore dollars a month on Substack. Free subscribers receive the exact same deep dive analysis 7 days later. The critical difference is your operational timing. And in public markets, timing is the entire game. Let us summarize the core operational directives. First, you must shift your annual contribution execution from December to the very first week of January immediately. Securing that extra 12 months of uninterrupted compounding growth across every single calendar year adds over 12,000 Singapore dollars in pure terminal portfolio value over a basic 10-year horizon. Stop waiting until the end of year rush. Make the change today. Second, open up your wealth portals and audit your account statements immediately. There should be absolutely $0 sitting in the default cash account earning 0.05%. Manually transfer every single dollar of idle capital into high-quality income assets that cleanly clear our 4.7% yield hurdle, instantly turning a leaking tax shelter into a highly resilient wealth compounder. Proper capital accumulation is completely meaningless if you stumble at the final hurdle. You must map out your exact 10-year withdrawal sequence at least 24 months before hitting your statutory retirement milestone. Careful chronological planning prevents your mandatory distributions from overlapping with active income streams, completely neutralizing unnecessary tax exposure. I am Iggy, forensic investor, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's Elite Investors get 0-day access, link in the description. The window is already open. Every single month you delay your active allocation decisions is a month of guaranteed wealth erosion. Stop letting your hard-earned tax savings quietly decay in a zero-interest banking vault. Click the link below, secure your lifetime zero-commission access, and fortify your income floor today. This video is a paid partnership with Longbridge Singapore. It is intended for general awareness and does not constitute investment advice or a recommendation to buy, sell, or otherwise engage with any investment products or financial services. The author is not a licensed financial advisor and is not offering financial advice. All views expressed are solely those of the author and do not necessarily reflect the views of Longbridge Singapore. All investments carry risks, may not be suitable for everyone, and you may lose your investment principal. Past performance is not indicative of future results. You should seek independent financial advice if you are unsure about any investment decisions. This advertisement has not been reviewed by the Monetary Authority of Singapore.